Acha ji, as we begin, the first thing, if you could kindly tell me, is that what do you understand, or what's your current understanding of what's the break-even point, what's break-even sales, and yes. Hmm. Without even referring to the book, have you heard of this term before, break-even point or break-even analysis? No? Okay. Acha, break even, it refers to the situation for every business. We have already understood that businesses, their primary aim is profit maximization. And when a business, it goes for profit maximization, a few things it comes across is that there is a revenue. We have already understood what revenue is. It's that it's the amount that you get for selling your products. Then from this revenue, you have to deduct, from this revenue, you deduct what? You deduct the costs, and once you deduct the costs from the revenue, you get profit. So a business could be in either of the two situations. Either the business is making a profit or the business is making a loss. All right. So what is the exact I haven't started sharing concept board with you. Just a second. Okay, do I need to share it here? Yeah, you're referring directly to the concept board. Hmm. Okay. So what I was saying is that a business, it could be facing the situation where it's making a profit, or it could be facing a situation where the business, it's incurring a loss. Okay. So what exactly is the point at which the business, it starts making a profit? Okay. Or in other words, what exactly is the number of units that the business has to sell at minimum so that it does not incur a loss? Okay, this particular point where the business, it's neither incurring it's neither earning a profit nor incurring a loss, this is called break even point. So break even point, break even point. Acha, why is it not writing? Where am I writing? There is too much information on the board. After today's class, if you could please let me know how much you have already noted, so I'll erase that, and then we can just keep the remainder of the stuff. Why is it zooming out? I didn't do anything. In fact, just wait for a second. Let me remove these things so that we do not have glitches during the class. And what about my remaining handwritten stuff? Shall I keep it? Shall I let it stay? But please use this weekend to note all these things down. Hmm. Hmm. Acha, because it's my own notes that tell me this thing. Did you write down this cash flow thing that I told you? This cash flow statement that we made the other day. You wrote it down? Here. Acha, and what about the cost notes? Did you take those down as well? Hmm. Okay, okay, okay. Remove the table. Okay. Ha 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 ha. Just a minute, please. Okay, what I'll do is I'll try to let everything stay over here for today, but I'd again request you if you could take these down as soon as possible so that I can remove everything. I'm letting everything stay as of now. Acha. So break-even point, we mentioned that it is the point at which the business is neither making a profit nor it's incurring a loss. So no profit or no loss. Okay, we can calculate this break-even point in a number of ways. We'll learn two specific methods. One is using graphs, and the other is using the formula or mathematics. Okay, so graphs and numbers. Let's begin with the numerical calculation of break-even analysis. There is a formula that's given in your book, but before I get to that formula, I'll give you a story and we'll play out a scenario so that you understand this thing better. Acha, the story that we are going to play out is, let's say you are running a food stall, okay, and at that food stall you are selling just one item, and that one item is Ankit's special dish, whatever special dish you are selling. That's the only item that you sell. Now your the costing of this business, or the profitability of this business is run in such a way that every item that you sell it for 20 dirhams. So AED 20 is your selling price. Hmm. This is your selling price. Your cost is just 5 dirhams. AED 5. This is your cost. Cost being the direct cost, the variable cost, we'll call it. Acha, we have already discussed what variable and fixed costs are, right? Can you please quickly remind me what variable and fixed costs are? Anytime or on a specific condition? Hmm. Good. All right. So variable and fixed, it is with regards to production. So fixed cost is, we are saying it's fixed with regards to production. No matter if you produce more or less, if we production goes up or down, fixed cost doesn't change. As for variable cost, it changes with the level of production. It varies with the level of production. Okay. Acha. So this is your production or output. If, in case you're not producing, you're just trading things. Acha. So your variable cost for making this dish that you're selling for 20 dirhams is just 5 dirhams. And the space that you're occupying, they asked you for a monthly rent of 15,000 dirhams. AED 15,000. So my question now is that how many units should you sell so that you earn neither a profit nor a loss? You'll calculate and give me your answer. Hmm. Mhm, mhm. So here is the scenario that you're selling a dish, and this is your main business. You're selling just one item. This dish that you're selling it for 20 dirhams. And each unit that you sell, each serving of this dish that you sell, it costs you 5 dirhams to make this dish. And then you have to pay 15,000 as rent to the authorities for, I mean, you have set this up in a mall, and you have to pay this amount to the uh, mall administration for your rent per se. So the question now is, how many units should you sell so that you earn neither a profit nor a loss, or in other words, excellent. How do you come up with this figure of 1,000? Hmm. Perfect, perfect. So if we take whatever you have told me, the thing that we do is we take the selling price, which is 20, and from selling price, I deduct variable cost 5. So per unit, I'm earning 15. This particular amount, the sales price minus variable cost, this is called contribution margin. Note it down. Contribution margin, or sometimes it's written in the short form as C/M. contribution margin is per unit that you're making in terms of the difference between the selling price and variable cost. Okay. And now if you're making 15 per unit, out of this, you have to recover a total of 15,000, which is your fixed cost. So we take the formula for break even point is fixed cost divided by contribution margin, or in other words, we can write fixed cost divided by selling price minus variable cost. Okay. Acha. Let's play this thing out in actual, that actually if you sell 1,000 units, which comes out to be your break even point in this case, what would happen? So I'm taking three production points over here. One is for 1,000 units, one is for 999 units, and one is for 1,001 units. Just a unit more and just a unit less. What would it do? Okay, so for sales, if I sell exactly 1,000 units, my sale would be 20,000. My total variable cost will be 5,000, right? If I deduct total variable cost from the sales, I get contribution. Contribution is how much? Contribution is 15,000. And from this 15,000, if I deduct 15,000 of fixed cost, I've got only two types of cost, variable costs and fixed costs, right? So if I deduct both types of costs, eventually I'll get the profit for the business. So if I deduct 15,000 of cost from this, I'll get zero profit. Got it? Which part did you not get? All of it. So I'm calculating what would happen if I sell exactly 1,000 units. If I sell 1,000 units, I'll get some revenue, right? What would be the revenue if I sell 1,000 units? 20,000, because I'm selling per unit at 20. What will be the total variable cost for the business? Each unit, it costs 5,000. So if I deduct this 5,000 from 20,000, where do I get 15,000? If it is for a single individual unit, this 15 over here, if it is for a single unit, it is called contribution margin. And if it is for a like numerous units for a particular level of production, then it is called contribution. Single unit is contribution margin. For a particular level of production, it is contribution. Okay. So how many costs have I deducted already? I have deducted the variable costs. The costs that remain to be deducted, they are the fixed costs, right? So fixed costs, they'd stay 15,000 no matter if I'm producing 999 units, 1,001 units, 0 units, whatever units, fixed costs would be the same. So now from this contribution of 15,000, if I deduct the fixed cost of 15,000, my profit is 0. Okay, so that proves if I sell exactly 1,000 units, I'll earn neither a profit nor a loss. Okay, let's do it for 999 units now. Please give me what would be the revenue for this business if they sell 999 units. Hmm. Hmm. 19,980 would be the revenue. What will be the total variable cost? 4,995. What will be the total contribution? 14,985. And from it, if I deduct fixed cost, I get a loss of 15 dirhams. Okay, so just reducing the production by one single unit, it turns the business into a loss-making operation. And the similar way, if I increase the production by just one, it will give me a profit of 15. Let's quickly do that too. 20,000, sorry, 20 into 1,001. It's not that we do not want profit, we are deliberately selling it. We'll come to, okay, so the way we use break even analysis is that if you say you are setting up a business, now the question is that how does it come into play? It's not that a business deliberately sells at 999 units. When you're starting a business, let's say somebody told you that there is a market for this thing, it's a very running item, and you can sell 900 units for it per month. If you don't know whether at 900 you'll be making a profit or loss, you shouldn't be launching this business. This is the calculation that you should be doing before launch of the business, right? So this is how the business it gets to know that what's the minimum that it has to produce and sell so that it starts earning profit. So in other ways, another scenario, this break-even analysis can be used is, for example, a business, they have just started the business and they have a projection that year after year their revenue will grow. So the projections are that in first year they'll sell in the first month they'll sell 500 units, in the second month they'll sell 900 units, then they'll sell 1500 units and onwards. Okay, so the business it runs for the 2 months and then they say we are not making a profit, so let's just call it quits, let's just quit the business. This wouldn't be the right approach because we know that the business eventually it will break even because it will go beyond 1000 unit barrier, and before that it's not wise to expect profit because you can't earn a profit before that. But eventually yes, the business will become profitable. So when exactly should you quit a business? At what exact output should you start expect earning a profit? Below what output, if the below what level if the output falls, the no matter what you do the business can't earn a profit. So this is how the break even it helps us. Not that we are deliberately trying to operate at a point where we are not making a profit. Okay, so this is a guiding mark, this is not a target. Target is that minimum you have to sell break even. Anything above this, if you are able to sell, then it makes sense to enter into this business. If you are in under no circumstances able to sell beyond break even, then you shouldn't be doing this business at all, because you'll never break even, you'll never make a profit on this business. Okay, acha, let's just quickly do for 1001 units as well, please. 20,020, and the costs would be 5,005. So the contribution it would be 15,015, and eventually the business it will earn a profit of 15. Okay, so precisely at this point, below this you don't earn a profit, ahead of this you start earning profit. Fine. So this is how we do it, and the main thing that you have to remember is this formula, that break even is fixed cost divided by contribution margin, or fixed cost over selling price minus variable cost. One thing. So another thing to remember over here is that this gives you break even point. Break even point means the level of output. This that we are calculating over here, 1000 units, 999 units, this is the level of output. If somebody asks you what is the break even sales of the business, the break even sales is the sales that you have to make so that you start earning. If you are making a sales of 20,000, then you'll break even. If you're making a sales of less than 20,000, then you'll be earning a loss. Okay, so we can speak of break even both in terms of point, which is the output, or we can talk about break even in terms of revenue or break even sales. Make sense? Shall I repeat, or did you understand this thing? Okay, so here we calculated, if for example for BE point is the level of output. How many units should you sell? And break-even revenue is how much should you earn in terms of dirhams, dollars, rupees, pounds, euros, so that if you earn this much, then you'll break even. C/M, contribution margin. Hmm. Contribution margin is the difference between selling price and variable cost. Selling price minus variable cost is contribution margin. And then contribution is total sales minus total revenue, revenue minus total variable cost. So revenue minus total variable cost. If we are doing for a single unit, then it is contribution margin. And if we are doing for a higher level of output, it's contribution. Understood? The next thing is the difference between break-even output and break-even sales. Over here, the break-even output is 1000 units. How many units or how many dishes or how many servings should you sell so that you break even? Break even sales is how much should you earn in terms of money so that you break even. So break even sales is 20,000 dirhams. Understood the difference? If you want to calculate break even sales, you could get a question where they ask you to calculate break even sales instead of break even output. All you'll have to do, you multiply break even output with the price. So I'll write over here, in order to calculate break-even sales, to calculate BE sales, there is a direct formula as well, but this one would be easier. Step 1, calculate BE point. This, I think they haven't discussed the break-even sales thing in your book. They have discussed the, but you could get a question on it, because it's just logical extension of this thing. Then you multiply break even point with selling price. This gives you break even sales. Okay. Acha. Now I want to, if you have noted this down, now I want to move to the graph explanation of this thing. Okay, so the way we do it with graphs is, where did it go? Here it is. I need to move it to a side. Ha 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 ha. Acha ji, the thing that will be useful for us over here is the cost graphs that we studied in the last class. Okay, how exactly? So we have got on y-axis the price or cost. So I'll write, excellent. So I'll write price slash cost, or instead of price, I'll write revenue slash cost. Revenue slash costs, and down here I'll write quantity or output. Acha, the way we studied this thing is, we mentioned that there is an upward sloping, there is a line for fixed cost. Okay, for now I'm going to ignore this fixed cost for just a moment. Okay, right now what's concerning me, because I want to make a point, let's consider just the variable cost. For variable cost, we said that as the output increases, the variable cost would increase. Okay, my question is that if I draw a line for sales revenue of the business, okay, if I draw a line for the sales revenue of the business, what would it look like? Would it be a horizontal line, or would it be an upward, I mean, an upward line with just like total variable cost? Horizontal straight line for sales revenue? No. So for total variable cost is this. I'm asking about sales revenue. So let me write it over here. Sales revenue. You understand what sales revenue is, right? From selling. Excellent. So what exactly should total revenue line look like over here if you could draw? Excellent, excellent. So one thing we know, it would increase as we increase the level of output. The next question is, so I'm drawing two lines over here, one this greenish line and the other this blue line. What do you think the sales revenue would be out of these two? Huh. For any business, for I don't think this is there in your book, this particular question that I'm asking. The question is, should the revenue line over here be this green one or the blue one? What does the green line mean? And what does the blue line mean with reference to the white line? Okay, remember, hmm, the green one, fine. Why? Why can't it be the blue line? Answer is correct. Mm, okay, but why can't it be the blue one? The blue one can also show how much revenue is made. Very good. You're partly right. You're just not hitting the nail on the head. The thing is that for, let's take any output. Let's take this output over here. For this output, this is the variable cost, right? At any given output, the business, it would have more sales revenue than the variable cost. Imagine a business. Look over here. Variable cost is the cost that varies with the level of output, right? So let's say any particular business, the costs that you're incurring to make a unit, let's say you're selling the same dish that you, if it took you 21 dirhams to make that dish that you were selling a while ago, would you sell it for 20 dirhams? You would never sell it for, if somebody asks you for 20 dirhams or any price less than 21, you'll straight away refuse. So it means your selling price, it is always going to be more than variable cost, otherwise the business would be loss making. For one unit, for 1000 unit, for 10,000 units, if your selling price ever is below, because you can never, you can't even recover the variable cost, how will you recover the fixed cost out of the selling price, right? Okay, it might have become a bit tricky. Uh, Let me put this aside. So the point that we have to remember out of this whole situation is that the business, it will have a selling price, it will have a sales curve just like the revenue curve, sorry, total variable cost curve, and the sales curve, it will be the sales line, it would be above the total variable cost line. Okay, or it will be a bit steeper than the total variable cost line. The other thing that we have to remember is that if I remove both total variable cost and the revenue, what would the total cost line look like? We have already studied that it would start from the level of fixed cost and then it would go upwards. This is what the total cost line looks like. Agreed? So it includes both variable cost and fixed cost. Okay. Now we know that the total revenue line, it will have a slope, it will be slightly steeper than this line, and it would start at origin and it would go upwards and it would intersect this total cost line at some point, right? So that means this point over here where the total cost and total revenue. So at this particular point, total cost and total revenue, they are the same. So if I take this output, let's call it Q1. What is the total revenue at this output? V1. And what is the total cost at this output? Also V1. Okay. Let's take any output less than this. So let me take a point over here, Q2. What is happening at Q2? If I extend it up to the total revenue line, this is the revenue over here, R1. And what is the total cost at this point? C1. So at this Q2, revenue is less than cost, right? So any point to the left of Q1, any point to the left of Q1, since the blue line is above the white line, so that shows that the cost is going to be more than the revenue. So this, if I'm producing a quantity less than Q2, less than Q1, it means I'm making a loss. If I'm selling any quantity less than Q1, the total cost curve will be above the total revenue curve. So it means this whole region over here, this is a region of loss. If I'm producing any quantity Q2, Q3, Q4 that is to the left of Q1, I will be making a loss. Agreed? And if I'm selling any quantity to the right of Q1, so any quantity over here, uh, let's say Q5, Q6, Q7, whatever. Hmm? Okay, okay. I'll repeat this whole thing of. I will. In fact, let me erase a few things. You understood till the point where we got the. Okay. So this is the total revenue curve and this is the total cost curve. For any curve, even let me remove the total revenue curve. This is the total cost curve that I have. If I take any output, for example, this Q1 over here, and I want to know what is the cost at this for this output Q1. How can I do that? I will extend a line from this Q1 up to the cost curve, and then I will extend it to the y-axis, and this point, this will be the cost. Okay. If I want to do it for point Q2, I want to calculate what is the cost at point Q2. All I'll have to do is I'll have to extend a line from Q2 up to the cost curve, and then I extend this line further to the y-axis, and this will be the cost for this level Q2. Is this much clear? How we get costs? Similarly, if I had to do for revenue, I'm removing this cost thing now and I'm doing it for revenue. If I have a revenue line which looks like this. Okay. So here is my revenue line. The same way I was doing it for cost, I will now do it for revenue as well. That if I want to calculate the revenue for Q1 or Q2, all I'll have to do is I'll have to extend a line from Q1 up to this curve. Okay. And then I will extend it to y-axis. I'll get whatever the revenue is for this quantity Q1. Okay, ji? This R1 or whatever I can name it. The only point that we have to learn that for any output, if I want to calculate a particular phenomena and on that particular level of output, what I'll do is I'll extend the line from that output up to the curve, and on y-axis I will have corresponding value. Okay, so on y-axis I get the relevant revenue for this one, R2. Understood? Okay, now I'm drawing both the lines total revenue and total cost. Shall I draw separate graph for this one, or shall I do it on the same one over here? I can do it on this one. Okay, okay, okay. So this is my total revenue line. I'll let it stay total revenue. And now on this total revenue, I'll also draw total cost, which looks like this. So I label it total cost. Is this much clear? If I take the point Q1 and I want to calculate what is the cost and what is the revenue at this point, from Q1, I'll extend the line up to the graph. The blue line is the revenue line. Okay. And then I will extend it to y-axis. So this over here tells me that R1 is the revenue at Q1. Okay. R1 is the revenue at Q1. Now I want to calculate what is the cost at Q1. Okay. So in order to calculate cost at Q1, now I will extend the line from Q1 up to the cost curve like this. And then from the cost curve, I will draw it up to the y-axis like this. So this C1, this is the cost for Q1, right? Did you okay. And now I can see that C1 is more than R1. So that means my cost is more, my revenue is less. So I'm incurring a loss. Loss. Cost is above revenue. Just look over here on this diagram. Your cost is more, your revenue is less. So this means you are making a loss. Got it? Now let's do it for point Q2. Acha ji, again we'll do the same thing. First we'll calculate the revenue and then we will calculate the cost. Acha, so in order to calculate the revenue, the first step is that I take the output and from this output I extend a line up to the revenue curve. And then I extend this point from the revenue curve to the y-axis. So this is my revenue. Let me call it R2. So this means if I'm selling an output Q2, I will make a revenue R2. Acha ji, if this is the revenue I'm making, now I'm interested in calculating the cost at this output. Let me label it blue so that it's identifiable. So this was for revenue. For cost, I will again from Q2, I'll extend the line total cost, excellent. And then from total cost up to the y-axis. So this is the total cost at Q2 output, right? And this cost I'll call C2. So for Q2, I can see that revenue is more than cost. It means that I am making a profit equal to this amount. Understood why we are getting a loss at Q1? Cost is higher, and here we are making a profit because the revenue is higher than cost. Okay, now I want to remove these markings for Q1 and Q2. I can let it stay, but it will become too complicated. Let's have it stay and then see. Let's take point QX. a special q or just q. Okay, this point q. What's happening at this point? If I try to calculate the revenue and costs, so first, in order to calculate revenue, I extend a line up to the total revenue curve, and then I extend this line from the total revenue curve to the y-axis. Y-axis. Okay, so this gives me the total revenue at point q. And if I want to calculate the total cost at point q, turns out that it is exactly the same line. So it means at point q, the revenue and costs are equal. At point q, revenue is equal to cost. Okay, so it means this is the break-even point. So this over here, this point q, it will be called break-even point, BE point, and this revenue over here, this will be called break-even revenue or break-even sales. Okay, understood? So the different ways you can get questions on this graph is that, for example, they give you a particular output and they ask you what is the revenue that they are earning at this output. So you can extend the line up to the total revenue curve and then extend it again to the y-axis, you'll get the total revenue. They can ask what's the total cost that you are incurring at particular point. Again, you'll take the quantity, extend the line up to the total cost curve, extend it to the y-axis, you'll get total cost. Okay. The second thing to learn is to identify whether at a particular point a business, is it making a loss or is it making a revenue. So I'll write these things down over here. Number one, calculate cost slash revenue at a particular output, for a particular output. You know how to do this now, right? The second thing that we learned is whether there is profit or loss at a particular output. ठीक है जी. The third point that we have learned is how to calculate break even, both break even point and break even sales from this graph. So the point where revenue and cost curves intersect each other, that is the point that the business it break evens. In fact, let me turn this black so that you are able to better see this thing. Okay, so I told you that this point Q, this is the break-even point, and this sales over here, the sales that it corresponds to, I turned this black too. Wow, how efficient of me. And this sales over here, this is the break-even revenue or break-even sales. Understood? All these, the 3 points that I've written on the screen. Any confusion on anything that you say that you have written this point, but I don't know how to do this? You understood all 3 points. Okay, now the use of break-even analysis, that what is this break-even analysis used for? Yes, sir. I've already told you, I just want you to repeat it. So in simple words, it helps us identify the point at which the business it would stop making losses, or beyond which the business it would start making profits. Okay, now as we discussed before and you rightly pointed out, that why would a business deliberately make a loss? The business wouldn't. It's just that the business knows that if I sell anything less than this, it's but logical to expect profit at that lower level of output. Okay, the same way, the more a business sells ahead of the break even point, the more safe it is from making losses, right? So the next thing I'm about to tell you, look over here closely. This additional output that the business sells above the break even point, this is called margin of safety. The output that a business sells beyond the break even point, that is called margin of safety. Okay, so for example, in the last case that we discussed of your food stall, we said that your break even point was 1000 units, right? Let's say your actual sales is 3000, or let's say 3500 units. Actual sales is 3500 units. So we can say your margin of safety is equal to actual sales minus break even point. Okay, so your margin of safety over here turns out to be 3500 minus 1000, which is 2500 units. Simple. The same way we calculate margin of safety in units, somebody could also ask you to calculate it in terms of revenue or sales. It would be whatever is the break even sales and your actual sales revenue. The difference between the two, it would be margin of safety and revenue. But I doubt you get a question, even though it's something very simple. But for some reason, I think you won't be asked that thing. Anyways, if you are asked, you know how to calculate it. All right, all right, all right. Acha, we have studied how to calculate break even using a graph and using calculation. We have studied what the break even it's useful for, why a business calculates this thing. The last thing to understand is that even though it looks to be a fine, complicated formula and a technical calculation, everything fixed, no loopholes at this stage, the break even point analysis, it has a few shortcomings. What are the shortcomings of break-even analysis? Very good. So let me give the heading over here, shortcomings. So a business, it's all the analysis, whether it be future cash flow, the predicted cash flows of the business, whether it be predicted income statement, whether it be predicted sales, anything at all. A model is as good as the values put in it. You put wrong values in the model will give you wrong answer. You misestimate your fixed costs, your variable costs, or your selling prices, your break-even analysis would be wrong. Okay. Acha, the business may end up, let me just compare, erroneous values will give erroneous output. Acha, if a business spends elsewhere, how does that affect the break-even analysis? Okay. The other thing is that it's not exactly a shortcoming, but right now we calculated it assuming that the business it's selling just one product. Okay. In reality, businesses, they sell multiple products, and each product, it has its own costs and it has its own sales revenue or selling price. Even then we can calculate the break even point, but it becomes too complicated. Hmm. No, that is the point. That is in fact a shortcoming. Fixed cost, we have assumed this model will work only as long as fixed costs are fixed. But turns out when you are tipping your toes into the stuff and you're actually carrying out the business, you get to know that uh, fixed costs are not even fixed. At time, even fixed costs change. So fixed costs, the simple way to understand this is they are fixed up to a particular level of production. Beyond that level of production, the fixed cost, for example, your factory, it has a particular output capacity, let's say 5,000 units. If you want to sell 6,000 units, 10,000 units, 15,000 units, then your fixed costs, they'll rise. They'll no longer be the same. Okay, so fixed costs are not always fixed. That is the shortcoming. But for the break even analysis, we have to assume that fixed costs are not changing. Fixed costs, the way I'll write it is that fixed costs may increase in long run, and the break even model, it only works if fixed costs do not change. Okay, the third shortcoming, even I've forgotten, let me check again. The third shortcoming was yes, limitations is perhaps a better word to use. That's the first one you mentioned. This one, this one, this one. So even for let me say, for fixed costs may increase in the long run, even for the fixed costs and variable costs, we have assumed the variable costs also to be fixed. That, for example, fixed as in per unit they are fixed. But if we are buying stuff in bulk, we might get discounts. So, for example, you were selling this dish making rice. You now you see that your sales is good. Now you start buying the raw material in bulk. So, if you buy raw material in bulk, your variable cost, which was 5, it might decrease. They'll give you discounts on bulk buying, and now your variable cost, which we assumed to be 5, it will no longer be 5, it might decrease. So that's the second point. The third point that we are making over here is that we are making this assumption that whatever we are producing is getting sold. All production, yeah, all purchases are sold, which is not necessarily the case for an actual business, where some of it might get left in the form of inventory. Or the business, they might deliberately overproduce in order to have some inventory at hand. Over here we are assuming, see, we are saying for this output, this is the total cost and this is the total revenue. Fine, this is the total cost and this is the total revenue. But what if this cost is incurred and the inventory is not sold? So for example, you're in the business of making furniture. You make beds. Okay, you make a bed, so you have incurred the variable cost, but you haven't sold it yet. You're keeping it in the inventory, so you'll record its cost, but you will not record its revenue yet, right? But over here, for the break even analysis, we are making the assumption that whatever we are producing, we are also selling it. Everything is sold. Hmm, hmm. So, for just a general rule, anything can happen. Yes, it's a valid thing in the discussions, but when we are specifying in the exams, we get marks for specifying. We have to specify that what are the things that we are saying that can happen. Okay. That's it for this chapter, by the way. And I'll strongly recommend that at least for this chapter, go through it today after a couple of hours or later in the evening, but make sure that you go through it today, because these things, they are a bit technical for your level, and if you don't, chances are that they'll have to be re-explained. I mean, I've got no problems in re-explaining the thing, but what's the harm in getting grip of the things in the first revision? All right, any questions? What questions? Acha, shall we uh, uh, what I meant was that all these calculations at first, they might seem a bit too complicated. How about we go through the MCQs right now? Now, okay. Just a second. Just a second. You have your book with you? Yes, the first one. If you could please read and let me know your answer, please. You gave the right answer. It wasn't mentioned in the formulas that we discussed. Let me tell let me tell you how you arrived at that answer. So for break-even point, we know total revenue is equal to total cost, right? And then total revenue is equal to total variable cost plus fixed cost, right? So if this thing is 5.6 million and this thing is 2 million, but natural, this thing would be 3.6 million, right? So we can write at break even point, total revenue is equal to total cost, and then you can use this equation. Make sense? Your answer is right, by the way, 3.6 million. So next one, please. 50,000 watt unit. Wrong. It's 50,000 units. That was the formula. I told you this is the formula for calculating the units. Okay, this is 50,000 units, not $50,000. Acha, if I were to ask you what's your break-even revenue? Excellent. That would be 1 point or 12.5 million, something like that. 50,000 into 25, correct. 1250000. 1.25 million. Acha ji. Next, sir, question 3. Acha, let's see how we do this one. So first we'll refer to the formula that break-even point, this is equal to, break-even point is equal to fixed cost, selling price minus variable cost. So now plug in the values. Break-even is 5,000. Fixed cost is how much? 20,000? 20,000. Okay, 20,000. Selling price is how much? 20. And we have to work to work. So yes, exactly. Take this as x. So this gives me 20 minus x is equal to 20,000 divided by 5,000. So this will give me 4 is equal to 20 minus x. And then 20 minus 4 is equal to x. So x is equal to 16. A variable cost is 16. Okay. 20 minus x is 4. So minus 20 plus 4 is equal to minus x. If you bring 20 to the other side, it will become minus x is equal to 4 minus 20, right? So this will give minus x is equal to minus 16 or x is equal to 16. Got it? Acha ji, the last one please. An increased in fixed cost excellent, excellent. Acha, this thing I didn't draw over here. Let me do this last thing and then we'll call it a day. The shifts in the curves. If it becomes so what if the curves shift, then what? That's what I was about to tell you. If they becomes no problem. I'm about to move it away. Acha, I'll remove everything from this one except for the break-even part. So this one goes away, margin of safety stuff goes away, this goes away, these go away. This, so this is the break-even revenue, break-even point, break-even stuff. One second. This I delete. Acha, this I can delete. Just a second, sir. This I can delete. This I can delete. And this is the break-even point. This is the break-even revenue. No confusion on this. Just a second. क्या बदतमीजी है? Why wouldn't it go away? This two please go away. This two please go away. The point that I'm trying to make now is that what would happen if the total revenue, if I increase the selling price. If I increase the selling price, the effect would be that total revenue, it will increase far more sharply. So it will become like this. Okay. So my break even point will shift to the left, or I will sooner break even. Makes sense as well that if I'm selling things at a higher price, other things being constant, now I'm making more revenue sooner and I will hit break even sooner as well, right? Similarly, if I decrease the selling price, the total revenue curve will not rise as sharply and it will lose its this slope. It won't exactly, yes, the gradient will decrease and the break even point will shift to the right. And logically, it makes sense as well that if I was getting break even at a point when I was selling goods at a particular price, now if I decrease the price, I will hit the break even point later. Yes. So this is the effect of change in increase and decrease in price. Understood? The opposite is the effect of increase or decrease in variable cost. If variable cost increases, then this curve, it will rise more sharply and my break even point where the total revenue and total cost intersect, this moves to the right. Yes. So I will hit break even at a later point, and if my variable costs they decrease, then this total cost curve, it will lose its gradient and I will hit break even at a sooner point, right? The effect of fixed cost is that it will move straight upwards or straight downwards. I mean, maintaining its gradient, it will move upwards or downwards. So if I increase the fixed cost, again, I will, the total revenue and total cost, they will intersect at a farther point, or break even point will be at a later point. And if the fixed cost is decreased, this curve would move straight downwards. I mean, maintaining its gradient, it would move downwards, and I will hit break even point sooner. Make sense? I was drawing it over here on the boards. You are able to see it because you have the concept board open on your end. Acha ji, that's it. I'll give these